one of the most important tools in investment analysis. It's called bond valuation. Today we will break down what is bond valuation, why it matters, and how it's used to make financial decisions. So stay tuned with us as we explore how this theme meets real-world finance. To make this practical, we have selected LOLC Holdings PLC, one of the Sri Lanka's leading diversified financial conglomerate. It started as a leasing company in 1980 and has now expanded into finance, insurance, agriculture, leisure and more. Because of its active role in financial sector and its use bonds to raise capital, LOLC is the perfect company to study in this bond valuation. Let's start with what is a bond. A bond is essentially a loan, but instead of borrowing from a bank, organization like government or companies borrow from investors. Imagine a company needs money to grow its business, so they issue bonds. Me as an investor buy a bond from them. Then they promise me to pay 1,000 after 5 years. That is called par. And the date I get it back is the maturity date. Until then, the company pay me 100 every year. So that is called coupon. Rate is 10% of the par value. The day they give me the bond is the issue date, and the redemption price is the amount they give me when the bond ends, usually 100,000. Now, as an investor, I ask myself, is this return worthy? Is this company strong enough to pay me back? So, that is where the required rate of return comes in. It's how much return I want for taking the risk.
Hi, I am Javed. I am going to explain the time value of money. It means the 1 rupee today will be more than that in future because of its earning potential. This is the foundation of investments. There are two measures in this case. First one is present value. This is the current worth of future sum of money discounted at specific interest rate. Second one is future value. This is how much the present value will grow in the future. We also deal with annuities, which are series of equal payments paid at a regular basis, like the annual interest from a bond. Second one is perpetuities, which are infinite annuities, like some special bonds that pay interest forever. In summary, time value of money helps investors to decide bonds' future return are worth the price today. Thank you.
Hi, I am going to about the bond pricing. Actually, bond pricing is meant by the present value of the future cash flow. Mainly, bond pricing is mainly depend on the bond pricing, maturity date, and market interest rate, and also market structures also the impact to the bond pricing. Let's see the LOLC issued bonds. LOLC has been issued the bonds, mainly issued bonds under face value rupee 100 rupees and the coupon rate under 10.25 and the market interest rate 11%. And most probably they have issued the bond for the 5 years. Most of the LOLC and also the other bank also issued the bond mainly for 5 years. As per this calculation, final bond price is 97.19.
Good afternoon. I just want to know what is the bond price. Can you explain further what is the yield?
Yeah, I will explain. Current yield measures the return an investor earns from the bond's coupon payment relative its market price, not considering time value or capital gain or loss. The purpose is it's shown how much cash flow you are getting right now based on what you paid for the bond. I will show you the calculation. This is a current yield formula. That is annual coupon payment divided by bond price into 100. According to LOLC, the coupon interest coupon payment is 10.25. That bond price 97. That current yield come to 10.57%. Yes. Then I explain yield to maturity. That is the rate equal to present value of the future cash flows to bond's current price. That purpose is comprehensive yield measured and compares the different bond regarding the coupon or price. This is a bond yield measure calculation.
Okay, Vedu. So nice explanation of the yield. And next we are moving of the practical application of bond valuation. I will invite to this one. Turuma, can you explain for the practical example and application related to bonds valuation?
Okay. How investors compare bond using a risk and return? For example, LOLC offers different bonds, type A and B. Type A and B have a 5-year term, but B provide quarterly income with slightly lower risk. Ideal for retirees, type C gives us a higher return of 12%, but also has a great price risk and due to its 10 years duration. Investors also look at yield to maturity. For instance, LOLC 5 years bond has a yield to maturity of 11.17%, much higher than a government bond at 8.5%, showing an extra credit risk.
Yeah, that is correct. But nowadays we need to consider interest rate and duration. Do you know that one?
Actually, what is interest rate and duration?
Yeah, please. Ankit bro, yes, you please explain what is the interest rate and the duration. I want to need a brief knowledge of that.
Yes, Sajat bro. Okay, I will explain for the interest rate, risk and duration. Okay, sir, firstly I would like to explain what is the interest rate. Okay, interest rate risk refer to the risk the bonds market value will decline to an increase in interest rates. This under I will explain for the two part. That means the two part means I say two relationships. Okay, so first one is interest rate. Can you know for the interest rate increase and decrease? So, firstly, I would like to invite for the interest rate increase. What about for the our bond price? Okay, so interest rates increase or rise, bond price also fail. That's the reason of depend for the each company and economic policies for the inflation relationship. Next one is when interest rate fail, so bond value also increase. Okay, so yeah. Now I am told risk and duration. Then I will go for the interest rate risk for the bond valuations. Okay, I will explain for that. This is small example. So for we are choose for the also choose for the company LOLC issues 3 type of the fixed rate debenture. Okay, so fixed rate debenture under type ABC, and so we also know for the rate 10.25 and 9.85 and 12. So maturity date of 5 years and 10 years. So both are annual, quarter and annual. All these are fixed rate bonds which are more sensitive to interest rate changes. For type 1 C, for C type 1, so 10 years and high interest rate risk. That means C also 12% is the interest rate, and duration is 10 years. That means the duration is long for the rise and increase for the duration. So also risk also increase. So second type of the type B, so quarterly. Do you know for the quarterly means the 4 months? Okay. So type B 9.8, so 5 years. Then quarterly payment. That means we have get for the quarterly payment for this debenture. Okay, so that type of the debenture low risk due to frequent cash flow. This means so also percentage is low. That means C, the combination of C also percentage is low, and years is 5 years, and also years also low. That means of the risk is very low. So third one is type A. So type A 5 years and annual. That means annual means after 1 year we can get for the payment. So we can give for the payment. So moderate interest rate.
Yeah, Atik bro, now I understood interest rate. You please explain what is the duration?
Yes, Sajad. Okay, Sajad bro. That's a duration measure a bond sensitive to interest rate changes. It's the weighted average time to receive all cash flow and express in year. That means higher duration is more price sensitive, and lower duration is less price sensitive. Okay, then I will explain for this one is a PV example. Okay, Sajad, you can ask for the duration of some previous example A and B, A and C and B I also choice. That type of the high risk and high return. That means so longer time investor one choose for the C, and short time investor also choose for the B. That means long time investor is duration also high. That means high risk and high return related this. And this one is so low return and low risk. Okay.
What is the credit risk? Credit risk that the bond issuer will fail to make the interest payment, repay the principal on time. It directly impacts the safety of the investments. The high credit risk, high required return for the investors. However, what is the role of the credit rating agencies? In Sri Lanka, credit rating agencies like the ICRA Lanka and the Fitch Rating or Moody's, these are evaluate the bond issuers, the financial health and the ability to meet their debt obligations. These assign rating that help to investors judge the creditworthiness of issuers. And the LOLC credit rating, LOLC PLC 2021 debentures issues was rated. What is the ratings are in this Lanka is stable by the ICRA Lanka Limited. What this means, A rating investments grade strongly, capacity to meet financial commitments, the stable outlooks, no immediately expectation of the rating change, indicates the moderate credit risk. Yeah, the fourth one is how credit rating affects bond pricings are in Sri Lanka. There are three types of the rating grades are using in Sri Lankan companies. The first one is AAA, AA. This is a very lowest risk and lowest yield. The second one is A to BBB. This is a investment grade. This is a moderate yield. Third one is BB and below. This is a non-investments, and this is a very highly risk and highly yield. The last one is and there are another examples are in this one. 5 years government bond yield is 8.5%. At the same time, LOLC 5 years bond yield is 9.85%. The difference of the 1.35% reflects the credit risk premium. It's the final one. What are the importance in credit rating investments? Help to compare the different bonds quickly, and the support to the risk-based pricing, ensure the transparency and the market discipline.
I am going to explain about 4 key market factors that affecting bond valuation using LOLC as an example. First one, interest rate. This is the most influential factor. When interest rate rise, bond price fall because new bonds offer better returns. An example, LOLC is a fixed 10% bond value, become less attractive if a market rate increase 12%. One, inflation expectation. When inflation rises, the real return on the bond payments decreases. Investors then demand high yields, causing price to drop. An example for long-term bonds like LOLC. LOLC 10 years bond type, rising inflation reduced its value. Third one is credit rating. A downgrade in a credit rate increases the risk production and lower bond prices. Example, if LOLC credit rating drop, investor will selling, reduce demand and the price. A stable rating likes support investor confidence. One is equity conditions. Bonds that are easily tradable are more attractive. Its example, if LOLC bonds are not attractive, is a secondary market. Demand and the price may drop due to low equity.
Let me talk about valuation of special bonds. What are special bonds? Special bonds refers to debt instruments that have unique or standard features compared to regular fixed rate bonds. These features affected how they are held, rated and risk assessed. Common types of bonds: zero coupon bonds, callable or puttable bonds, inflation related bonds, floating rate bonds.
This debenture issue include standard fixed rate bonds. One of the instrument type B has the specific character, quarterly interest payment. This payment structure give it a shorter duration and different valuation approach due to more frequent cash flow. Even though LOLC's bonds are not exotic, type B qualifies as a specific bond due to its quarterly structure, affecting how it is valued and perceived in the market. Such bonds appeal to investors seeking frequent income and reduce price volatility.
So that brings us to the end of the journey into bond valuation. So what we have learned is bond valuing isn't just about numbers, it's about how interest rate, risk, time and market all come together and affect your bond price. Whether you are an investor and trying to make smart decisions, or you just want to know about the basic concepts of the business finance, just knowing how bond works is really helpful. Hope you guys get a clear idea about the bond valuation. Our group members, please like and subscribe our videos. Thank you.
Thank you.